Hey, I'm Mike McGreen. Charitable giving, it's a noble thing, and many charities are worthy of our support. Today, we're going to briefly explore some effective charitable giving strategies. First, as you know, when you donate money to a registered charity, you receive a tax credit. The charity gets the use of your money while you benefit from a credit on your tax return, which effectively puts money back into your pocket. And depending on where you live, each province has its own tax credit rates. And when you combine that rate with the federal rate, you'll receive the combined charitable tax credit. Okay, now we're going to talk about two specific strategies. First, charitable foundations. You may look at the option of setting up your own charitable foundation. This is a neat strategy and is not always just for the ultra wealthy. In fact, it's a fairly straightforward process with not a lot of costs or headache involved. We've helped clients set up their own family's foundation account where they have donated money to their own foundation. This would be an irrevocable donation, meaning that once the funds are donated to the foundation, you'll receive a tax slip immediately for the amount donated, and then we work together with you and invest those dollars on your behalf. This is a longer term strategy because each year you then direct us on how you want to disperse some funds from the foundation to a charity or multiple charities, all from the growth in the foundation account. As a general rule, CRA requires that you disperse at least 5% of the value of your foundation each year to charity. Since you received a tax slip at the outset when you first made your irrevocable donation, you do not receive a tax credit on each subsequent disbursement from the foundation now going forward. But then the charity of your choosing gets to benefit from those dollars that you've authorized us to disperse for you. So there are times when someone would look at setting up a foundation, yes, because they're charitably minded, but they also may want a larger tax credit in a given year. For example, if someone, say, sold their business or maybe they received a large severance and they now have substantial taxable income in a particular year, they could look at setting up a charitable foundation. They'd make a substantial donation so that they can receive a sizable tax credit in the year that they really need that tax relief. This is a great way of establishing a legacy of giving because you don't need to disperse the funds from the foundation all at once or to only one charity, as you can take your time, you can select multiple charities and even select different charities each year going forward. Maybe it's fun to change it up a little bit from time to time. You can also make it a family affair where you discuss your giving plans with your kids or your grandkids on what charities you all want to support that year. And as you can see, your positive impact can be long lasting, not just to the charities, but also onto your next generation. To make this process simple and hassle free for clients, we've partnered with a company called Charitable Impact. They're a Canadian firm established back in 2011 with the sole purpose of helping Canadians support charities. Charitable Impact has helped disperse over $1 billion towards charities on behalf of about 167,000 Canadians. The size of the account with us, though, will vary, but it depends on your circumstances. Typically, the minimum needed to set up a charitable foundation with us is in the neighborhood of $30,000, but there's no limit to the upper end, and it could easily stretch into the hundreds of thousands of dollars, if not more. Now on to the second strategy. Donating shares, donating publicly traded securities or mutual funds. If you hold investments in a non-registered account, and if those investments are in a capital gain position, you could donate those shares to a charity. You'd receive the tax benefit, which is based on the current market value of the shares that you donated. And the added benefit here is that you actually avoid having to declare a capital gain. This is a more tax smart way of doing it because avoiding having to pay the capital gains tax on the shares. Otherwise, if you ended up choosing to sell the shares first and then donating the cash to charity, you would rather donate the shares to charity, avoid the capital gains tax, versus, again, selling the shares first, paying the capital gains tax, and then sending that cash onto the charity. Hope that makes sense. I'm going to tie it all together. You could also donate your shares to your family's foundation account. You'd avoid paying the capital gains tax again on the appreciated value of those shares, and you'd also receive a tax credit for the total donation. Finances are fun, And these are some really neat ways of designing things. And if you know what is available and what the benefits are of certain decisions over other decisions, then it's even more fun because you really then get to fulfill your true financial goals. If you have any questions or you want to explore any of this in more detail, definitely reach out. Thank you for your time and thanks for watching.